Okay.
Waiting for webinars.
So hopefully y'all enjoyed the walkout song. For some of y'all that have been here more than once, you'll know it's my favorite, and that doesn't seem to change. It's hard to find an interesting tune that has to do with money. So if this is your first time and joining us, welcome. I see some familiar faces already, so welcome back. Anyway, so we've done several of these. We started these kinds of series last April, so we're almost up to a year worth of doing LinkedIn Lives, always with the theme of CEO money manners, helping business owners and their executives better understand how to use their financials. So in this series, and I always break these up into a series, and that's for your benefit. I mean, I could talk about numbers, financials, metrics all day long. In fact, if you're on my team, you probably resent the fact that I can talk about these things all day long. So just like a lot of our topics, when we went through accounting wellness or your financial insight about how to use your balance sheet and income statement, we've broken this up into parts. So the 4 parts that we're going to cover over the next couple of months, because we do this every 3rd Friday of every month. So today we're really going to go over an overview about the why and how of metrics, because we all hear about metrics and we all hear about dashboards and everything else, and they sound really cool and really sexy. And it's like every CEO's favorite toy. And instead of topics through July, that's supposed to say topics through April. So forgive me on that. But dashboards and metrics, especially dashboards, they tend to be every CEO's favorite toy, and certainly a huge resource for most CFOs. And for really good accountants, it's a great resource for them. But we're really going to talk about why, because it's dashboards and metrics are one of those things that we all aspire to, but frequently we never get to implementing them and understanding how to use them and how to use them to change our company as we move forward. So for those that have watched the Shark Tank, one of the things that we get from the Shark Tank, and I'm going to open this up for Q&As here in a little bit because I want y'all's input on this, but the universal truth that we always hear at the Shark Tank is people that are presenting, the sharks, if you will, always telling us like, man, you don't know your numbers, or you don't know what your numbers are telling you about your own company. And that's one of the #1 reasons that they back up from investments. And I share that with you, not because you're going to go on Shark Tank, but if you're ever presenting to a bank, to possible investors, to buyers, or if you have to present your numbers to a new customer, because sometimes that happens. They want to see your financials to make sure that you're really strong before they engage with you. Just know that it's very important that you know what your numbers are telling you about your company. Just assume that you're going in Shark Tank. So some of the universal truths that we talk about here at New Life is your financials. Let me move my picture out of the way here for just a second. They're nothing more than a historical reflection of your people, decisions, behaviors, processes, and systems. Now, the reason I really love metrics, analytics, KPIs, and trends is they are really good about helping your people understand the impact of their decisions. Impacted decisions are very hard to see on just a single set of financials, and sometimes they're hard to see even if you have a rolling 12 of financials. But you'll see a couple of charts that we're going to go over today just as examples. And when you use charts, when you use KPIs well, and you trend out the KPIs about how they're moving over time, you will be able to see when certain decisions and behaviors have changed, or processes or systems, and what the impact is. That's where it's really fun. And I know, you're probably thinking, gosh, financial metrics and fun, Burt, I'm not so sure we're on the same page, but that's where it's really fun for me. So we'll just leave it at that. So as we go through here, one of the key things that we think about is your CFO and the use of these numbers. They should be organized in a way so that your people know what behaviors they need to change. We like to talk about Jeremiah 11 about, oh, the plans I have for you, declares the Lord. But some of those plans are embedded in your numbers, and being able to track how you're tracking with your plans is not just as simple as looking at your balance sheet or income statement. So with that said, I'm now going to open up the mic because I really want to understand. I know what I have on my agenda here, but I'd love to have some of your input about some of your big questions and things that we need to solve for you as we jump into metrics and KPIs. And yes, we're going to hit some of our favorites, but I want to start with you first. So if anybody wants to just kind of lean in, tell me, what you're really curious about learning, and then we can kind of peel into making sure that we're going to address those either in this session or in the other sessions that are upcoming. So does anybody have a current set of dashboards that y'all are looking at? And how useful are those to your management team? All right. Well, I guess I'll just move on. One of the things that we find when we're talking about metrics is one of the reasons that metrics are so valuable is because of this right here. Too often, the CEO or the C-suite is inundated with tabular data, spreadsheets, big reports, and everything else. But what they're lacking is the connection between those reports and the behaviors. And sometimes they're so overwhelmed with just spreadsheets and typical reports, they really can't see what's going on. And they don't have the time to dive into that more meaningfully with their folks. So one of the great things about metrics, et cetera, is the fact that you can get to really great information on your financials super fast, probably much faster than you can just by looking at your financials. Now, if you're a really strong CFO or accountant, a lot of times those people can look at a big spreadsheet and see the trends just readily. They can look at your AR and tell you what's good, bad, or indifferent. Most casual users of financials can't. And so where metrics are really very powerful is connecting those data points and those relationships between your balance sheet and your income statement, because those are interdependent. And then also helping you to highlight those trends and everything else, trends about how those things are shifting over time. So as we talk about a lot of times, in almost all of our segments, this is what I call your income statement. Most CEOs are on the left-hand side of this sandwich picture, and that they're looking at their revenues and their net income only. They don't pay a whole lot of attention to everything else. Really good ones that when I do this presentation, we'll talk about, well, I also look at my gross margin. But the thing about your income statement is all the really good stuff is the stuff that's in between. And what makes it really great for your folks is connecting those dots between the cheese and the tomato and understanding what those relationships are. And then maybe understanding what's going on with that top piece of bread and other things in your balance sheet. That's where KPIs and metrics really add tremendous value. Again, this is my favorite metaphor about your balance sheet, that it drives the fuel for your company. That could be liquidity. Obviously, it's cash, but most people don't know how much is enough. What is liquidity? We hear the word all the time, especially if you're dealing with your banker and everything else like that. But does the average CEO really, for a mid-market company, really understand liquidity? And do they really understand, do they have enough liquidity? When we get into metrics, we try and make them meaningful to a casual observer. So during this thing, if you see metrics that we're promoting and everything else, and they're not meaningful, let us know, because that means that we have more work to do. One thing before I go forward into some of the other things, into more of the details about what we're going to be presenting, I want you to also know that at the end of this, if you send me a message, you will also get a description of our favorite metrics, how to calculate them, and we'll even give you a spreadsheet so you can input your own data to start. So it'll just be an Excel spreadsheet for you to start out with. And we're also going to talk about some of our favorite tools to really make your KPIs and everything else very easy to implement and very easy to set up for your entire team and your company and automate those throughout at a very low cost. So as I tell everybody in the world, my favorite beer in the world is cold and free. So just know that, because I'm very, very cheap and I like things that are highly functional and very cheap. So as we go through this, when we are looking at either trends or your KPIs, and even with KPIs, I actually like to see the trend of the KPIs, because it's the comparison of numbers over time that makes the numbers more meaningful. So if I just give you one number about revenue, you don't really know if the company's doing well or not, because you don't know what it did last month. You don't know what it did last year. And that's particularly true with like gross margin, your gross margin percent. So the trends and comparisons help us to explain why and what is going on in the company. And are we really improving, or is that just a good number that's in front of us? So as we start to really study some of the critical factors about your trends and KPIs, what they are designed to do is to help us identify key trends and where processes or decisions got broken. For example, we had one client, we were showing their AR turnover or days sales outstanding, which is how fast do you collect your AR. And we were showing the trend over time, and it was pretty consistent. And then it suddenly started to break and go up. And I asked him, that had happened about a year and a half previously, which was really easy to see when you're looking at a long-term trend. It says, okay, so we now have 50% more AR stuck on our balance sheet, and it seems like it changed about 18 months ago. What happened then? And when people saw what was going on the timeline and where the pattern shifted, they started thinking and just kind of bouncing ideas around. And then somebody raised their hand. I think it was the VP of sales. And he goes, oh my God, that's when we changed our contracts. That was hugely profound, because what they quickly discovered in re-reviewing their contracts, it had tons of T's and C's, but it didn't have the payment T's and C's as clearly defined as it was in the last one. Therefore, the commitment that they had with their clients was much looser, and their clients weren't being called on it, and their accounting folks didn't have the enforcement behind it. So ultimately, that led to bigger AR. It ultimately led to them changing their contracts and getting that straightened out with their customers. So just as a quick example about sometimes static individual numbers don't tell us the whole story, let's look at one example here. So this is just any old company. It has AR 1.5 million, or 1,550,000 to be more precise. So if we're looking at that one number, what does that tell us? Not really a whole lot. We don't know if this is GE or this is a company that does $100,000 a month. So we just don't really know if that's a good number or bad number. But let's look at some other data points. Oops. Why? So this is supposed to be progressing here, and it's not. Oh, I know what's going on. Hold on just a second. So I had to put this in the presentation mode to make it actually work. So 6 months ago, that was the AR. So now we can ask different questions. AR is growing and everything else, but we're still not really seeing the trend or if that's a good number or bad number. And why do we not know if it's a good number or bad number? Because we really don't know what's going on with sales. So when we start to connect this balance sheet number with some of the income statement numbers, we start to get a different perception. So in this case, 6 months ago, revenue is 1.2 million. We had 1.3 million outstanding. So we had, I think mentally I'm going to do the math here. That's AR of about 40 days, somewhere around there. But now when we look at the 1.5 million and know that our revenue has gone way down, wow, we have a totally different picture about our AR. One that's very different than when we were just looking at this. This picture of AR says that we have big problems going on. But how bad is bad and how good is good? Well, that's where just a simple metric really helps to define that. So what this says is, oh my gosh, we went from 34 days to 45 days of AR outstanding. That's a 31% increase about how slowly people are paying us. And you want to see somebody that's starved for cash, it would be this company. Because not only are their sales down, their collection is slower, and they're probably not too far away, unless they had a really strong cash account before this, from getting into, we're going to have to start moving the chairs around on the decks of our boat so that we can keep everything whole and keep everything moving. That's not a healthy picture to be in. And for most people sitting in your executives team or at your, what we call a monthly summit, they're not going to readily pick up how good is good and how bad is bad when they're looking at your financials. That's really the juice behind doing good metrics and everything else. So if metrics and KPIs are so valuable, why is it that so few people have them? So one of the reasons that I'm sorry, I got a little bit ahead of myself, so I'm coming back up there. So let's go with this cash deal, and then we can start looking at cash conversion cycle. This is one of my favorite balance sheet metrics of all time. So I actually had one client, and this company didn't have AR, but the client that I'm talking about did. And the person who did their business goes, why are we so concerned about, days sales outstanding or our AR? We always collect it. So what does it matter if we're collecting it this month or next month? I said, gosh, Lee, that's a great question. So let's pretend that we only have AR, and AR is our only, in this case, it's primarily inventory, but we only have AR, and we know we're going to collect it, but it takes us 3 months to collect it. Okay, that's your normal 90 days. Sounds horrible to me, but for you, that's fine. If it takes 90 days to collect it, that means that we have to be able to finance 90 days worth of our business to keep it running. So that's one of those things where when you start to understand that growth can really hurt you. So if I were to double our sales, it means that I have to take this new 90 days and increase the amount of cash I need or funding to finance that growth. And hopefully that makes sense where if I only had 30 days outstanding, I need only 1/3 of the amount of cash or liquidity to fund that business. The cash conversion cycle really tells you from, hey, when I first order goods from a vendor to when I sell it and collect it, how many days total do I have before I go from cash out to cash in? And so cash conversion is really the combination of how much days of inventory I have, how many days of sales, DSO, which is the AR metric, and then less how many AP days that I have. So we bought it, we sold it, and then we have some time from our vendors, free financing. And the cash conversion cycle, so you can see in this case, this blue line, it's getting better and better. And what that tells us with this light blue line, not the green line, but the light blue line, is this company is becoming, their risk profile about how they're doing is becoming better and better. It's also telling us that they could grow more easily because they are generating cash so quickly, they don't have to borrow as much cash just to fund their growth. And since we're on kind of this whole liquidity measure, I will tell you, here's one of my favorite liquidity measures in the world. We call it OPLIC, for operating liquidity. Now, for some of y'all, the standard metrics that you would hear about would be, my current ratio, my quick ratio, and that's also called my asset ratio. Unfortunately, if I throw out those terms, most people don't really understand what those are. If you're a controller, a CPA, CFO, you do know what those are. But I'm also surprised sometimes that even those folks don't really know how to use that to drive performance in the company. So we came up with this thing that we call OPLIC. And again, this will be in the sheets that we can send out, but I'll give you the simple calculation of OPLIC. So for us, OPLIC is 100% of your cash plus 80% of your AR combined, divided by your monthly average COGS and operating expense. So what does that tell us? So what we've done in doing those two things is we took our two most liquid assets, being AR and cash, and then we divided it by the things that are consuming most of our AR and cash, and that's our COGS and our operating expense. So OPLIC, we stated here, as you can see in this green line, it's number of months that we have liquidity. So this company has basically 6 weeks of liquidity. Generally, we want you to have at least 2 months of liquidity, preferably 3. And here's why. If you have 3 months of OPLIC, that you could run your business out of what's in your cash and your AR for the next 3 months, if nothing else came in, it gives you 3 months to correct course if you stub your toe. It gives you 3 months to go and maybe negotiate a different line with your bank before you're in deep trouble, right? So number one is OPLIC gives you breathing room. That's why we want 3 months. And out of those 3 months, we really want you to have 1 month worth of cash to fund your COGS and your operating expense. So if you looked at just cash and you divide it by COGS and operating expense, we would want you to have 1 month, because if you're building and you're collecting well, you're pretty consistently replacing that. And that's a good, healthy thing. The other thing that Oplic does that's not as readily as apparent is now we've connected the balance sheet things down to our spending behaviors. Because most CEOs and most of your COOs, they're looking at the income statement. So we've connected this balance sheet thing over to the income statement, which they usually manage like a hawk, right? So that they're typically right on top of those things. The other thing that Oplic will do is, I call it a cookie jar metric. So what do I mean by that? So even in New Life, what we do is we always try and have 2 or 3 months of Oplic, right? And as our Oplic improves to where we have, gosh, maybe 5 months of Oplic, well, that's our signal that we can make a distribution to the shareholders without stressing the performance of the company, right? So you build up Oplic to 5 months. You can take 2 months worth of either tax distributions or other shareholder distributions out of the company, back down to 3, maybe back down to 2. But you haven't sacrificed the company. You haven't taken too much capital out of the company and then leaving the company at risk or in jeopardy. Because a company that's down to, like, especially 1 month, boy, you stub your toe on that thing and everything's coming unglued. Because at 1 month, I will tell you, your vendors know that you're in stress. Your customers likely know that you're in stress. So that, using Oplic like that, says we want 3 months, 2 months. If you go below 2 months for us, that's a yellow signal. If you go down to 1 month or less, we'd make that a red light in our world. So here's some of my favorite metrics. And if you want to take a picture of these screens, I highly recommend it, because these are not only some of my favorite metrics, these are probably some of the best places to start if you're going to have your own KPI suite and your own metrics. And again, if you ping me, we'll send you the calculations, the description of these metrics in more detail, and you'll get a spreadsheet about how to calculate them and insert your own data. So first and foremost, balance sheet metrics. And yes, I started with balance sheet metrics because it's stunning how little time the balance sheet is given by most executive teams. And if you're a finance person, the balance sheet's the most important of the two things. We'll tell people all the time, if your balance sheet is jacked up, then I know your income statement is jacked up. And if you're only looking at your income statement and your balance sheet is jacked up, then you're making bad decisions, or you're making decisions on bad data. So one of the things that metrics and KPIs can also do for us is help us to understand not only the health of our balance sheet and income statement, or the health of the company, it can also tell you when possibly an error occurred. So when things change, when we see some trends and everything else, and we don't understand why, well, it might be that the accounting team has messed up on some of their entries and something's not posted right. So these things help us to understand that. Quick ratio. So we talked about that. We actually use Oplic instead of quick ratio, but we have quick ratio up there because it's a more common term. And quick ratio is your current assets excluding inventory as a ratio to your current liabilities. Typically, you would want a 1-to-1 ratio on your quick ratio, meaning that all your current assets less inventory is equal to or greater than all your current liabilities. That tells us that, even if your inventory gets jacked up, you can pay your bills pretty timely. I still like Oplic because all my owners are looking at the income statement and have their focus there. Inventory turnover. This is where we get into days of sales outstanding, is really AR turnover. We get into days in inventory, which means how many days of sales do we have in our inventory? Most companies, have probably 2 months worth of inventory on hand. They have enough inventory on hand to fuel 2 months worth of sales. And then knowing that, it helps them to understand, okay, I always want 2 months. If I get below that, then I might be in jeopardy of not being able to sell stuff because I don't have the right things on hand. And then we also have days payable outstanding, DPO, which is your AP metric. That helps us to understand, are we mistreating our vendors? And also helps us to understand, are we using the free loans that our vendors provide us by giving us usually standard somewhere between 20 and 35, 40 days to pay their bills? Cash conversion cycles we just talked about is the combination of AR, inventory, less AP. Very important. Return on assets. I'm going to show you a different way to look at return on assets, but that's basically what are your assets relative to your revenue, right? Interest coverage. For y'all that have bankers, I like to see interest coverage because that's one of the most important things that my bank wants me to be aware of. Am I in a situation where I cannot routinely cover my interest payment? Debt to equity. Also, this is a very important one for you and your relationship as far as where's your capital coming from. Keep in mind that capital comes from one of three areas. You earn it, right? Net income. You borrow it from your bank, or you have investors that provide it as far as equity. The interesting thing there is the higher your debt to equity becomes, if you start having, let's say, a good company might have 1-to-1 ratio between debt to equity. That's a pretty good deal. Below one is really good. But let's say it suddenly goes to 4-to-1 for whatever reason, that you took a big distribution or whatever the case may be, your debt to equity is 4-to-1. Well, at some point, your bank's going to look at that and go, oh my God, if debt to equity is 4-to-1, we're really the equity and not you as a business owner. And they never want that to happen. So having some of these metrics helps you to understand how others may look at your company. And then total debt capacity. That's not a typical measure, but we do like to always monitor that. And debt capacity is really taking your EBITDA and then doing the calculation of if my EBITDA is, let's say, $100,000, and my bank wants me to have 4 times coverage on interest. So it's $100,000. And to get to 4 times coverage, that means that my interest can be, 25,000. And if I take my interest of 25,000 and I divide that by my average interest rate, it grosses up into the total amount of debt that my company could afford. And if I take that total, and again, you're probably rolling your eyes like, oh my God, he's going to talk formulas all the way now. But if you take that total and reduce it for the amount of debt that you already have outstanding, it'll constantly tell you your debt capacity, which is really good if you're in a hyper growth mode. It's really good if you're in an acquisition mode. So knowing what the banker's response would likely be when you go there and says, hey, we're looking at making some big investments and I want you to be my partner and let's talk about a loan. Just know that they're going to be looking at that capacity as well. As far as the income statement, some of my favorite metrics, revenue composition and concentration. So I want you to know where your revenue resides, what types of revenues do you have, what percent is in project revenue versus recurring revenue. Also want you to know for your top, 5 customers, what percent does that make of your total revenue? So typically I would say, if you have any one customer that's over 25% of your revenue, that's a problem. If you had those top 5 and they represent 50% of your revenue, that could be a problem. Because just 1 or 2 of those backing out, especially if you're at that person that has a single customer that has 25% of your revenue and one customer, that means that you're one decision maker away for some really tough decisions, right? For some really tough aspects and stresses within your business. The other one, revenue per head, one of my all-time favorites, because the biggest decision people make is how they hire, right? And let's face it, we're humans. We don't like to have the bad conversations. We like to have the good conversations. It's always great to say, Billy Bob, you're hired. We'd love to have you on the team. Most people don't like the conversation of, Billy Bob, we got to get rid of you, buddy. We just don't, our company's not big enough. So revenue per head helps us to keep in balance from our largest single cost, which is typically our heads. Unless you're in manufacturing or construction, headcount and people is your number 1 cost factor. So keeping that relationship between heads and revenue is very important. For most companies, and again, I'm going to exclude construction out of this, but for most companies, somewhere between $150,000 to $250,000 of revenue per head per year is a really good number. So if we simplify that and says, okay, at 250, well, you're basically down to a little bit over $20,000 of revenue per head per month. Now, how we use that a lot of times is, people come into the boardroom, they're excited, hey, we got all this great stuff, or we have this huge problem, and I want to hire 3 people. And I go, that's fantastic. I can't wait to have 3 more people there. But before we hire them, can you tell me how long it's going to be before we have 60,000 extra dollars of revenue per month? So whatever your number is, always challenge the people who says that's fantastic that we need more people. What's that doing to our trend of revenue per head? Is that forcing our revenue per head to go down, or are we just hiring fast enough to keep it from going up too much? Because revenue per head can tell you, are you properly staffed? It can also tell you, when are you supposed to be hiring? So let's say that we're back to $20,000 per head. And as we monitor revenue per head, if it goes up to 25, well, that's probably getting close to where we're stressing our people out. And we need to start the hiring process so that we can reverse that trend before it gets to 27 or 28. Because at that point, we are stressing our people out. It's also a trigger that says, oh gosh, we went from 20, but now we're down to 17. We need to stop all hiring. We're going to do a headcount freeze, and we may just let attrition go. And maybe if it gets close to 15 is when we start cutting people so we can get it back up to 20. So it's a good way to leverage your business up and down. So I'm going to show you a few examples of metrics and what was going on with these companies. And hopefully we can start to see to where metrics identify where behaviors changed or can be used to change behaviors. So here we go. This is from a client that was in manufacturing. And then we had EPH, just call that basically units per head or units per hour. So when you're looking at this, the left-hand side of the chart is when they really weren't measuring it. They were just, units per hour. They'd go all over the place, up and down, and things of that nature. And then what we did is the first red arrow is when we started publishing units per hour. And this company had people in their plant that spoke at least 2 different languages, I think really 3 different languages, and very few people spoke the other person's language. What we did is we created a very detailed chart that would trend this. Steve, could you do me a favor and mute? That would be great. Thank you very much. It's just so we could hear the paper shuffling around. What we did is we started measuring it, and then we would do a weekly chart that would show people, hey, last week it was up, it was down. And when it was way up, we'd circle that and do a call out bubble with, English, Spanish, etc. What was going on that caused it to go way up? We also did the exact same thing when it went way down. And this wasn't a chart that we had hidden in somebody's computer. It was a chart that we published in their break room every week, and they could see it, and everybody could walk by and see exactly what they were doing. And so that arrow is when we implemented the measures. And you can see very soon thereafter, their performance started to really smooth out. It wasn't nearly as volatile. Well, this immediately produced more stable gross margins, a more stable margin percent. And then later on, what we did is we incentivized the labor team. It says, hey, if you stay above the target level and improve upon that, then we will share some of the newly realized margins with you as far as bonus. So that ended up being very powerful for those folks. And you can see that it not only continued to be consistent, it started to go up. And then people became more and more motivated to do better and better. And what was great is because the individuals on the plant floor understood how their behaviors affected the numbers, they became the ones that started implementing the changes. So it wasn't the plant manager, although the plant manager is fantastic. The plant manager wasn't out there preaching. The plant manager was just helping to educate about how big is big and how much money. So when they'd come with new ideas, he could show them on the chart. It's like, hey, if we do that and that increases our units per hour to X, that means we've created this amount of resources that we can then share. It was a great deal. So this is one of my other favorites. And it should have been on that other chart back here as far as break even. There it is, break even point right there. So as we go down here into break even, The reason I love break even is just look at this. So we have break even there on the in the purple on the right hand side, and you can see that it's gone up and down. Well, what's also very interesting is look at break even's relationship to their gross profit. When their gross profit is doing strong and well, their break even point is lower. So I use this with salespeople and says, if we have good margins, we don't have to work as hard to make the money. So there's a very big difference. So when they were having poor performance, like down over here back in 20, they had to sell 4.4 million. But when their margins were really high, they only had to sell like 3 million. So knowing what your margin mix is and what that does to your break even, it's huge because break even is directly related to the risk in executing your business. I also use break even to talk to my salespeople. So let's say that I'm talking to my salespeople and they're talking about their pipeline, their all this other stuff in the CRM. What I want to do is challenge them. It's like, what are we doing right now to make sure in February that we have enough revenue to surpass our break even? And once they get good at making sure that they have closed enough business this month to make sure that next month is going to be above break even, then I'm going to stretch that out to 60 days. What are we doing this month to make sure that both February and March are going to be equal to or above our break even? They get good at that muscle memory. Then I'm going to challenge them. What are we doing now to make sure that February, March, and April are above? And if I can get them to consistently be looking 3 months down the road on break even to make sure it's equal to or better than, I will guarantee you'll never have a month where you're losing money. Not unless something big expense comes through that was totally anticipated. But if you're running your business smoothly and you're monitoring your break even, you're going to find out that all those months of negative results all go away. So I'm going to pop back up here just real quick about some of our other favorite income statement metrics. So we talked about concentration, gross profit dollars per unit. So this is really important to see, are we getting more for everything that we sell? Or are we just selling more? Just selling more is not necessarily a good thing, because if you're selling more, and let's say that we used to get $100 per unit, we're down to 90, that hurts because it's highly unlikely, depending on what your mix is, that your vendors are cutting you a break. You can also see that just in your gross margin percent. So if you're not trending your gross margin percent, that's absolutely one of the first things that you should be doing. The other thing that I'll look at is we talked about revenue per head, but one of the good things is gross profit per admin head, right? So we have direct labor that might be up there in our COGS, the people that are in the plant doing that work. But what this other one tells me is, how efficient is my back office and management team becoming? Am I able to leverage that guy that's doing my billing and AR collections so that, hey, I was doing 5 million, now I'm doing 10 million, but I don't need 2 people. The one person still can do that job, even though my revenues have doubled. Those things are really important, because if you can keep your gross margin per head and that's growing, you will constantly be dropping more money to the bottom line. It's one of the greatest measures of productivity of your administrative staff that you'll ever come across. And then, of course, the composition down here at the bottom, compositions of all my components of COGS, being direct labor, direct material, tracking those as a percent. Now, some of these things, especially this one, the reason I love this is there's direct accountability in your boardroom about managing those things. Let's say that your procurement person is part of your monthly financial summit. That person can immediately walk out that day if they see that the material percentages are starting to increase, and immediately go back and start peeling the onion back about which part of our raw material components or which part of our purchased goods is causing our materials to go skewed up. And they can either solve that by getting back with their vendors, like, whoa, you're not charging us as per our POs or per our contract, or your costs are going up and we need to go out and renegotiate. It can also be a trigger to your sales folks. And we've seen this in a couple of deals. Oh my gosh, we're losing some margin because we're not keeping up with the cost increases from our vendors. Don't be afraid of your price increases, because I guarantee you most of your vendors aren't. Break-even point we talked about. Customer acquisition costs. Another way of some of y'all can do that as far as especially tech firms. We're going to take all of our sales and marketing expense and divide that by every new customer that came in to help us understand what does it take us to get a customer? What is that investment? And then when you see customer acquisition costs really going down, especially if your revenues are picking up, man, you pour gas on whatever you're doing because now you found the thing that really drives new customers to the door and you want to do more of that. But just kind of monitoring your spend versus the economics of driving new customers. So customer acquisition cost is about the economics of getting a new customer. For those that have ongoing customers, let's say that, you could be a food manufacturer that's selling to Walmart and Walmart's ordering all the time. Or so in those cases, what you want to look at, what's my sales and marketing as a percent of revenue? How productive is my sales and marketing as an investment to my revenue? So if it was 10%, it's going from 10 to 11 to 12 to 15. Boy, I hope your margins are going way up because it would imply that your salespeople are not being nearly as productive as they were, and that your ROI on your sales effort is declining rapidly. It can be a trigger for, do you need to revise your compensation plans? Do you need to revise your commission plans? Do you need to revise your marketing plans? And then if you're in manufacturing, and especially if you're in construction, I want to know the number of months of revenue you have in your backlog or in your pipeline. When I used to have my other company, we were in commercial construction. And what we did all the time is I always monitored how much revenue I had, number of months of revenue in my backlog. And it was a real easy calculation. We're taking our backlog, dividing it by our average monthly revenue, and boom. And I always wanted to have at least 3 months of revenue in my backlog. Why? Why not 5? Why not 2? Whatever. But 3 was a good number for us. And here's why. My sales cycle, I'm sorry, I wanted 4 months of revenue in my backlog because my sales cycle was 3 months. And so having 4 months of revenue in my backlog always told me that if my sales cycle remains the same at 3 months, I'll be able to replace that revenue very easily. If my revenue and backlog went to 5 months, where I have even more cushion and less risk, that tells me I can go hunt a big elephant and not really risk the company because I took my eye off the ball of the ongoing risk deal. Also, if it got close to 3 or went below 3, it probably means that I'm going to do my best to take big deals off the street. And that might include some pricing because I have to feed this beast and then start rebuilding it. So it's a great trigger to use in that regard. One of my favorite deals that's not on either one of those two pie charts. So this is where we have gross profit per head and comp per head, kind of a pivot on the gross profit per head, per admin head. So in this company, you can see, let's just look really at the trailing 12 numbers, the light blue line and the yellow line. The other stuff bounces around, just weird stuff going on. So you can see that the average comp per head, 10, 9,000, they're hiring staff that are at lower levels and stuff like that to do more work, which is why it goes from 10 down to 9 and 8. But what's really going on is they're hiring people so fast, even though the comp is fairly stable, they're hiring so many people. Look at what that's doing to their gross profit per head. Their gross profit per head is really going down and down and down. And it's getting really close. So up here on the far left-hand side, they have $14,000 per head over and above their average compensation per head. As it went down into 17, you can see, okay, we're down to $6,000 per head. We're down to $4,000 per head. We're down to $3,000 per head. At $3,000 per head, I will guarantee you that they were in a tough shape. Now, what was really going on in this company is they had some significant issues and they were trying to really ramp up some new projects and some new capabilities, but those weren't going as well as they wanted them to. And so they kept on putting more bodies at it. And at the same time, they were diluting their profitability. And this helped them to go, oh my gosh, we have to figure out a different way to solve this problem. We have to slow down how much we're spending on curing the problem. So this really helped them to pivot very quickly and get down to conversations about how do we expedite these solutions instead of just throwing bodies at it. Here's another one of my favorite deals that we haven't talked about previously. But I'll tell you, you want to really understand where your company is relative to recession or explosive growth. This is a chart that comes from ITR, which is an economist group. A lot of y'all that are in Vistage know them very, very well. ITR is probably the #1 most requested speaker within the Vistage circle. And what this tells you is, in recovery mode, you're coming out of a recessionary period. You're starting to almost get back into growth. In the accelerating growth, it means that your change that you went from, hey, this year versus last year, I was growing at 5%. Now I'm growing at 10%. Now I'm going at 15%. So you're accelerating your growth. Right? The yellow line means that you're decelerating your growth. You're slowing growth, because I went from 10% growth, and I'll show you how this works in just a second, 10% growth to 8% growth to 5% growth. Those are warning signs that your business is heading towards possibly a recession unless something changes really quick. And then obviously we all know what the recession, you're going into negative growth, right? You're starting to decline in your total size. What's really interesting in this, and if you want this as well, I'll send it out. There are tactics that you can deploy depending on where your company is in this cycle. Happy to send that out. So let's look at a company that was actually in this cycle. So here's a company. And what we do is we take their 12 over 12, which would be, okay, we're going to look at January 24. Let's assume that we're already closed on this month because it makes the sample. We're going to look at the cumulative 12 months of January through last February as a number, and compare that to January 23 back to February of 22. And we look at those two numbers and like, how many dollars have they changed, and what's the percent change? And what this tells us is, you can see, gosh, they were accelerating growth. They went from 12, I'm going to call that 13% growth, up to above 20. They almost hit 30% growth. So their growth was accelerating until it wasn't, and started coming down. And then we do the same thing. That's the purple line is the 3 over 3. So we do the same thing with the most recent quarter worth of data. So that'd be January, December, and November of the most recent period compared to the exact same time a year ago. And we look at that because that's going to change and react more quickly, right? It's more of a leading indicator telling us, are we truly heading? So in this company, they were growing. You can see that the 12-month numbers start to come back up, and then it starts going down. And when it crosses that line, it means that, gosh, we are going towards a recessionary period unless something big happens. So it gives you some time to start changing the direction. But obviously, when the more reactive 3 over 12 crosses the 12 in one way or another, it means that the 12 over 12, the health of the company is getting ready to shift. That's what you really want to be looking for. And then finally, yes, they had one dip, but if you looked over here, now they've gone from not just slowing growth, they actually went into decline. Year over year, this most recent 3 months versus the same 3 months, they're now shrinking in size. So this creates a red flag. And using the tools that we can send you, you can start looking at different tactics to use in different phases. And this is a surefire way of making sure that you can protect yourself, even when it's only your company or your industry that's heading towards a recessionary type performance. And that's even if the rest of the economy is doing great. Your company and your industry, knowing this is fantastic. The other reason this is really important is, let's say that you're starting to get to decelerating growth, which again, I'm going to go back here. Decelerating growth, it says yellow line. Well, that's when you start taking cautionary impacts, right? I'm going to start hoarding my acorns like a squirrel, because that gives us the resources to survive well when our company does go into a recession. It also gives us the resources if we're really good once we hit this hard landing or soft landing and we start on the blue of we see recovery coming. If you're monitoring this, you will see recovery in your own company or industry before your competitors. And when you have that and you were planned and you saved up your acorns and nuts and all that other stuff, now you can go into attack mode because you know that there's light at the end of this tunnel before anybody else. So you want to grow real fast, go hire your competitors' best salespeople during this cycle when you hit the blue, assuming that you have enough acorns in your nest egg. So you start either buying people, you can buy assets, and you can buy companies during this deal, as long as you're confident, oh gosh, we've seen like 3 months, this trend has changed and we're back to our healthier path. Let's go and attack now. So you can see what's going on with this company, and they're into reconfiguring real quick. They're also into trying to promote sales so they can get this back up to a steady deal, because they don't want to get into 4 months of this, because at 4 months, you truly have a big problem. And you're probably looking at your company going into at least some level of temporary recession. So two other quick measures that we get into, fixed assets, revenues compared to revenues, total fixed assets compared to revenues. And this is just a better way of looking at asset turnovers. So in this company, it's a construction company, and you can see the assets are the purple, and the revenues were the blue. So we changed how that they were monitoring their assets, and we changed how their people requested assets, big equipment out on their projects. And what that allowed them to do is really radically slow down the amount of equipment they were buying relative to the revenue. And you can see how their revenue starts really coming up relative, and their equipment staying really flat, and it actually goes down a little bit. This company was printing cash because they are no longer consuming it all on equipment. And then we have billings in excess and cost in excess. I'm going to hold off on that. We'll come back to that when we get more into the balance sheet, because there's some critical questions that some of y'all have typically asked me in the past. If KPIs and metrics are so valuable, where does this process really get jacked up? Well, here's the number one reason why this gets jacked up, right here. I want you to look at that, and it's just a messy whiteboard. We've all seen messy whiteboards in our boardrooms. So what happens when you go into your boardroom and you go, hey, we're going to have a great brainstorming question or session all day today, and we're just going to come up with great metrics? Well, you end up with a ton of stuff, some of which is not pertinent, not important. So it's not the brainstorming session that's really important. What is important is to identify the 4 or 5, maybe 8, 9, or 10 that are really critical for your business, and start with those. And then once you have those, you educate people about what that's telling them, just like we did with the manufacturing plant. We educated the people on the plant floor about what this told them about their behavior. And then from their questions, we started to create the additional charts to give them the insight to the questions they were asking. I'm telling you, man, if you create KPIs and metrics and you start showing the trends, and your people start asking for the next layer of information so that they can understand it, you have hit utopia. You have hit financial metric utopia. Another thing that I'll tell you that's very important for successfully implementing KPIs and metrics is this: canary in the coal mine, right?
Hey, Burt,
Yep.
just so you've got like 4 minutes left.
Okay, that's good, because I don't have a whole lot more to go. Thanks, Lola. So really the canary is setting a target for all of your metrics. What's the level of performance that we want? So let's go back to days of sales outstanding. It may be jumping all over, but we want to see, a consistent, gosh, our target is 30 days. So what does your dashboard look like? Here's what we typically have right here. And I'm going to flip over and actually show you some of our live dashboards. So here we go. All right. So here's one of our dashboards. This is for a sample distribution company. But you can see over here we have AR days. And so if I click on this, log me out. So as I click on this, you'll see that with AR days, I can see how it's performing. And so we're doing much better than our target. We're at 16 days, target is 30 days. That's fantastic. We should also be fat, dumb, and happy. On inventory days, you can see that, okay, we're carrying, we did pretty good, but we're back to carrying too much inventory, because this is relative to our sales. This is fantastic. So the system that you're looking at right now is something called Fathom. I think if you looked it up, it'd be Fathom HQ. Yeah, so you can see it right up here on my screen. We have it privately branded, but Fathom HQ, super easy to start with, because it'll have some prepackaged metrics in there. And it's either, if you're on QuickBooks Online, it'll connect directly, and you can very quickly start getting into this. And it's actually pretty easy to master. It's extraordinarily powerful if you use it in total. This is what we use for almost all of our clients, universally. All of our clients are in this stuff, because what we've found is most CEOs and the C-suite are visual or tactile learners. Me putting together a big spreadsheet and dumping on them doesn't tell them what this tells them. And you know, there's different, we could look at their break even. We could look at, let me go up here, a different way of looking at it. So we had the results, the target, the trend, right? So we're either on target or not. But the trend tells us we might even be off target, but the trend is moving positively towards our target, which is a really good thing to know. In this case, we even set up alerts. So, gosh, we have alerts on inventory. It's at 70 days, right? We're the alert is set for 60. And this means in an alert, it's not only off target and it's trending bad. This means we need to take urgent action now. So again, numbers should create an appropriate level of anxiety for you or somebody on your team to take action. So with that, so jump down here. Convene is very much like Vistage. And if they have a very simple set, I use this when I'm talking to Convene people. It's a very basic set. It's in Excel. And again, we can send you our Excel spreadsheets for you to fill out. Fathom is a great tool that we highly recommend. It's our core reporting tool. You can see it's very inexpensive. It's very robust, database foundation, so you're not going to blow it up. But you know, do it yourself. Do it yourself. We think the KPIs are awesome. You can do non-financial analytics, and they have a pretty substantial library as far as training. Another one of our favorites is For Impact Data, and I'll tell you flat out, full disclosure, I'm an investor in For Impact Data. I did some consultation with them about designing some of their stuff. And yes, it is more expensive, but relative to its power, it's very cheap because what it will do, it'll dive into the customer level, it'll dive into the product level, it'll dive into the vendor level, and really help you understand what is the profitability and the trends of specific customers, specific products. It's fantastic in that regard. And relative to 500, that's pretty cheap. The other thing that's great about it, it's all done for you. They can usually get a company up and going in a week or two at the most. On some of the things about product and customers, that can take a little bit longer because of the data extraction. But these 2 and 3 tools are fantastic. They are a great place to start, whether you want it done for you or you want to do it yourself. These are my 2. So with that said, happy to stay here as long as y'all want, but open it up to questions and comments that you have. And again, next time we're going to go into income statement and then balance sheet. So we just did some sampling this time. So any questions from the folks?
Yeah, I have a question on the one dashboard that you showed. Looked like a circle with a bunch of squares on it.
Oh,
that you
let me
could
get
drill
to that.
down.
Yep, right there.
Now, is that your dashboard or is that the impact 4?
This one is a Fathom.
Oh, it is Fathom. Okay.
Yes. So this one comes out of Fathom. And what we do, John, is we will designate ourselves which ones we consider high, medium, low, etc. And then we call it work the wheel. And that we're going to try, we'll set these up and the targets, and we're going to try and make all the criticals go from red to green and the highs from red to green. If we do that successfully in the first 6 months of the year, then what we do is we're either going to change the ones around so the things that are still red get moved to critical, or we're going to raise the bar so that people react differently and increase the targeted performance. Does that make sense, John?
Yes. Can it connect to Google Sheets?
Yeah. You know, John, I'm spoiled because my analyst does that, but I'll tell you, once you, like for some of our clients that are on, let's say, NetSuite or on Dynamics, we will download their data into an Excel file, and within 5 minutes, we can load it back up and push it in there. So it should be able to work the same way with Google Sheets, to where if your system is connected to Google Sheets, you should be able to load that back up into Fathom in about 5 minutes.
Gotcha. Okay, that's yeah, because we've been we wrote our own API and we've been pushing data to Google Sheets so that way it's all automatic. We don't have to think about it.
Yep, you'll find that you could hit upload and everything's going to be refreshed just as long as, like for us, we'll do chart of accounts, and it doesn't matter where I put AR, as long as I have the account there, it's going to find it and put it in the right place for me, and I never have to jack with it again.
Okay. So right now, somebody's sending you an Excel file and you guys are updating it, correct?
Yes, or we generally have
Okay.
access to our clients' systems. So we'll just go in
Okay.
there and extract it, download it, and truly, once you set it up, and setup doesn't take that long. Typically, we will spend half a day on getting a new client set up and their KPIs done because the formulas are in there, and you can create all your own KPIs. So a half a day, I have this set up and it's ready to start using on the preliminary set. And then we just dive deeper depending on what looks like it's off track or what questions come up.
I think that's the only question I have right now.
Okay. Anyone else? I know I ran a little bit long, but like I tell you, I could talk about numbers and metrics all day long. And hopefully next time I'll be more honed in on the income statement drivers. Yes, sir, Mr. John.
Oh, I did raise my hand, didn't I? Burt, do you find that, in your role and when you're working with, say, company controllers, you're looking at a lot more metrics than you will bring to the attention of the CEO? Do you kind of manage that, or do you find that you get in a certain rhythm that, you encourage the CEO to look at 3, 4, 5? I think you mentioned this, but, are you typically looking at 20 metrics and you'll show your CEO 5?
That's a great question. That's a great question, John. Typically, I'm going to really lean in on my CEOs to make sure they understand what's the critical and highs. And then sometimes the medium and lows. The mediums, I just want to monitor to make sure it stays a low status. And a lot of times, although it's not really on this one, it's kind of on this one. The lows is where we're going to put bank covenants, debt monitoring things, so that we have an eye for what does the bank see when they see our numbers? What does an investor see? So if I have a private placement memorandum that has some monitoring stuff, I'm going to put those stats over here because I want to make sure that I'm in compliance. The other ones are driving performance, but so some of them are for our benefit and some of them are for the client's benefit.
Mm-hmm. And you obviously know this, but ROA is a sneaky good metric.
Oh, I love it.
Because, you can look at it, you start with, your income statement percentage, right? Your net income relative to your revenue.
Yep.
But then you take your revenue against your assets, right? And so you can see if your ROA is either improving or declining because of balance sheet issue and your asset turns.
Yep.
Or whether it's turning by your profitability. So that's a sneaky good metric.
Yeah, I love that. Especially for people like you and I, because I know that you're a very sophisticated financial executive. But when I was dealing with that one company, that's where we did, where is it? Where'd it go? Nope, that's not it.
But that was a good chart there too.
Yes. I'm trying to look at my gross profit. Where did that chart go? Oh, here it is. This one over here. So what was going on with this one, John, is the field superintendents and project managers that are out in the field, well, gosh, they were only being charged for the equipment based upon how many heads they had, not based upon how much they use the equipment. And so we changed that to reflect how much they're using, because what was happening, John, is the company has 2 big $1 million excavators, and I need one on occasion, but out of convenience, because I'm not being charged, I just let it sit on my job. So it's always there for me. But what that did is it created artificial demand just because of convenience of my PMs. Mm-hmm. When we changed that to where people got charged for the equipment based upon number of days they were using it, it was stunning how much equipment started coming back to the shop saying, oh, I don't need it. And that's what allowed them to change that curve and actually reduce their equipment total, even though their revenue went from average of 3 million, they're now at like 10 million a month. Mm-hmm. But and yes, their equipment has grown over that, but they really got back to at $5 million a month in revenue. And what is that? A 40% increase with
Yeah.
a net decrease in their assets, just because now people could see and feel the financial impact of better utilization on their jobs.
Yep.
They got
Yep.
bonus based upon the margin of their jobs.
No, that's great.
What other questions do we have? And again, I know I went over, but I guess it's like that song, "It's my party and I'll talk if I want to." I don't want to say cry if I want to. Nobody wants to be crying over their numbers.
No,
No.
lots of good nuggets in there.
All right. Any other questions? If so, I'll let everybody get back to their Fridays as they intended. And I hope you have a fantastic